which is a better long-term investment between Apple and Tesla. Elon Musk, the CEO of Tesla, stated during the Q3 2022 earnings call that I think on our earnings call that I thought it was possible for Tesla to be worth more than Apple, which was then the highest cap company, I think, in the market. Apple and Tesla are arguably two of the tech industry's giants. Tech enthusiasts are wondering which of the two makes a great investment in the long run. You definitely wouldn't want to miss this several years ago. Tesla and Apple have very little in common, except for the fact that both stocks are top 10 holdings in the NASDAQ composite and have been exceptional investments over the past decade. But while Apple stock held up better than the NASDAQ in 2022, Tesla stock has gotten absolutely crushed, down 73% in the past year. Timing the purchase of Apple stock well would have produced gains of over 370,000% between 1982. And now that is to say that inflation-adjusted equivalent of about $3,000 invested back then would have been worth around $1.1 million now over such a long period of around 40 years. It is hard to find another stock worthy of dethroning Apple as the wealth-producing king of our generation, that said. Tesla stock has been at least as impressive at producing astonishing returns, albeit over a shorter time frame since the EV company became publicly traded in 2010 Tesla. Shares have appreciated a whopping 9,330% over the past 12 years. It is not even fair to compare. The performances of Apple and Tesla, the latter has turned a nominal initial investment of $1,000 into $94,000 today, while Apple investors would have ended up with $17,000. Instead, historically, Tesla has been the better growth stock. This is also evident in how much more volatile and susceptible to large drops Tesla has been relative to Apple stock. It is important to keep in mind that a key trait of growth stocks is both high risk and high reward. An example is Tesla's annualized volatility since 2010 has been 63% versus Apple's 28%, and Tesla's worst drop at May peak since 2010 has been 61 versus Apple's 40%. Still, experts believe that Tesla is going to outperform Apple over the next 5 to 10 years. So when it comes to which is the better buy, it would be Tesla. However, Tesla is a far more volatile, risky, and stressful investment. And for that reason, it's a stock that's probably best avoided if you don't want to deal with the drama, if you have a shorter time horizon or have a lower risk tolerance, whether you love it or loathe it. Tesla is an intriguing stock right now because its fundamentals are finally keeping up with the price. This makes it harder to argue that the company is being priced for what it could become in the distant future now that the stock has crashed. Those who believe that Tesla is only a car company would have to see a multiplex increase in production and deliveries before they would be able to justify the company surpassing its previous all-time high. However, if you're among those who believe that Tesla can monetize its electric semi-truck, then you can't deny that the company has grown to be a very good one. Its industry-leading balance sheet, operating margin, top and bottom line growth, and free cash flow are just a few of the accomplishments in the last 2 to 3 years. Following in Microsoft's footsteps, robotics, autonomous and self-driving technology, and the expansion of its renewable energy sector might transform the company into something entirely new with a much greater valuation, all cold. Although the risk reward for Tesla seems reasonable at these levels, investors in the company would need to brace themselves for a rocky ride. Conversely, analysts think Apple is valued more fairly. In fact, the recent sell-off of Apple shares has placed the company stock below the $2 trillion mark for the first time in almost 2 years. It also represents the same market capitalization as when the stock was trading in August 2020. Given that Apple has lost 1/3 of its value in the last year, many think this is a good time to purchase Apple distributes. The company's new iPhone 14 Pro has been shipping less recently due to manufacturing issues in China, and there is concern that demand may decline as consumer spending slows in the current economic climate. These issues have also led some analysts to lower estimates for sales of iPads and Mac computers, which adds to concerns about lower earnings. While investing in Apple stock now carries some short-term risk, the company generates a lot of cash and returns for its shareholders in the form of dividends and share repurchases. Even though Apple's earnings growth is stalling this year, its stock price is currently trading at a better valuation based on the price to earnings ratio that has been seen in almost 3 years. A P of about 20 represents a good level to own this proven company without the risks associated with other less mature technology and growth companies. However, it may not be fair to compare Tesla a relatively young company to a far more established company like Apple. It probably makes the most sense to compare Tesla's performance in the past 12 years to the first 12 years of Apple as a public company between 1980 and 1992. In just 12 years from 2010 to 2022, an original investment of $1,000 would have risen to $4,385 thanks to Apple's respectable annual return of 13%. As previously mentioned, Tesla returned an astounding 43.8% annually, meaning that an initial investment of $1,000 would have grown to $94 just 12 years. It is important to keep in mind that Apple did not have an easy start as a publicly traded company and that it nearly went bankrupt twice. The company's fortunes were eventually turned around by the return of Steve Jobs as CEO and the release of the original iPhone in 2007. Nevertheless, it is clear that historically Tesla possesses a greater growth DNA than Apple, and since investors are typically forward-looking, we should also take into account potential future growth opportunities. Given the unexplored potential in fields like mixed reality, the metaverse, and even autonomous electric cars, may be viewed as a growth company. Of course, one has to think that Tesla's growth avenues might revolutionize Apple's product and service offerings, as it's difficult to see how smartphones and laptops the company has been revolutionizing the automotive industry. And according to Statista, sales of batteries and plug-in hybrid electric vehicles should more than double between 2022 and 2027. Tesla is the industry leader in this regard, and these numbers do not even begin to cover the other opportunities that Tesla may explore, which include battery applications outside of the automotive industry, driverless technology, and public transportation, including the anticipated autonomous taxi. To get right into the argument, sell-side analysts believe that Apple's EPS will continue to grow over the next 5 years, but only by 11% annualized on the other hand, and off of a much lower base. Wall Street estimates that Tesla's EPS will increase at an annual rate of 29 over the next 5 years. From a valuation perspective, Tesla more closely resembles a growth company than Apple, at least based on the anticipated bottom line trend. This is because it is trading at a 26x P for the upcoming year, which is significantly less than the ADS of early 2022 due to the recent collapse in share prices. Apple, on the other hand, commands a lower forward earnings ratio of 20x. Although Apple and Tesla may potentially drop significantly more, there are many compelling reasons to invest in either business right now. There are many benefits to shares of Tesla or Apple to a diversified portfolio. For more information, subscribe to this channel. Tesla and Apple are well positioned to weather a recession, even if it means short-term margin compression and slower growth. Each company also offers a path toward multi-decade growth by expanding the core business and also monetizing new investments. For Tesla, long-term growth means expanding its electric vehicle offerings outside of passenger cars and making money from software and robotics. For Apple, long-term growth means selling more consumer electronics while also growing its services, financial products like Apple Pay and Apple Card, as well as its entertainment services like Apple TV and Apple Music.